Welcome, traders, to this crash course on everything you need to know to get started trading futures. So a few topics we'll cover in today's video are going to be how the futures market works and how you can actually make money in the futures market. As we'll see in just a moment, these two things are actually not the same. We'll also talk about the critical concept of points and ticks and how we actually put a dollar value to our futures contract. That's going to coincide nicely with our common symbols because, as we'll see, points and ticks are going to depend on what symbol we're trading. We'll also cover margin and commission rates. That way you can make a better choice when it comes time to decide who you want to open a brokerage account with. And then lastly, we'll go over some tax advantages of trading futures. It's not something that's often talked about, but there's a huge advantage in terms of taxation on why you may want to consider futures over equities, options, or Forex. And then lastly, not listed here, is going to be some live price action on the futures market. And hopefully what that concrete real-life example does is solidify some of these ideas that we talk about so you're more prepared for going into the futures market. Let's go ahead and kick this video off. So to get started, we need to understand how the futures market was designed to work. If we think about the words futures and market, there's two main takeaways. The first one is obviously that we have a marketplace. We have buyers, number one, and sellers, number two, coming together to exchange things. If we think about the word futures, what we can take out of this is that this exchange here that we're talking about is going to happen at a later date, okay? But what are these things that we're exchanging on this marketplace? Well, historically, the futures market was designed to purchase commodities. And a commodity, if you're unfamiliar with them, is going to be a physical and raw asset that you can use to make other goods. So when we think of metals, we think of things like gold, silver, platinum, copper. If we think of grains, we can make food with grains. We have oil, gases, natural gas, all those different types of energy sources. There are other food items like coffee and hog. The list goes on and on. There's sugar, corn, soybeans. I mean, you name it. If it's a raw material, it can pretty much be traded as a commodity. And the key takeaway, remember, is that this exchange here is happening at a future date where our buyer and seller both agree on a price and a date, okay? So between the buyer and seller, we need a price and a date. Now, this may seem a lot like options contracts where we're agreeing on a stock price for the future. But the difference here is very, very critical. The buyer, if you're an options buyer, right? The buyer is not obligated to do anything. You just have the option to now purchase share prices at a certain price, right? But the buyer of a futures contract is obligated to buy whatever it is. Let's say it's commodity X for X price up here. They are obligated to fulfill their end of the deal, meaning they need to put up the money that they said they would in the contract when the expiration date happens. And the seller as well is also obligated to fulfill the deal. So the buyer needs to put up the money here, and the seller needs to put up the product or commodity that was agreed upon for the exchange. So that's the key difference here between futures and options. So if we dig into this a little bit more, why is this exchange happening in the future and not right now? Well, remember that this market was established a long time ago. And back then, buyers and sellers were, they were actually trading goods. And what they were trying to do was set themselves up for success. So our buyer over here on the left, he owns a steakhouse in Massachusetts. And our seller over here on the right, let's say she owns a cattle farm in California. These two people, it would make sense that they're trying to be as effective as possible in running their business. The buyer wants to be able to secure steak prices or beef prices at a good price. The seller wants to ensure that they're making money and hedging against future market volatility. Let's say that the price of beef goes down in the future. They're trying to secure some deals now so that in the future they don't have to worry about that risk as much. Do you see how that kind of works and why we're talking about the future now? It's a hedge to the risk that doing business proposes. So let's go through a few real life examples, right? they are going to be trading a contract for beef here that's going to be dealt in 40,000 pounds, and right now the current price is 85 cents per pound. So, that's all fair and good. The seller says, you know what, that sounds like a contract I want to be engaged in. I'm going to agree and therefore become obligated to sell 40,000 pounds of beef at 85 cents per pound. The buyer says, you know what, I like that deal as well. I think that that's going to be great for me and my business. I'm going to agree to buy those 40,000 pounds of beef at 85 cents per pound. Now, two things can happen as we go into the future. Remember that this deal is happening at some date, a later date in time, and not right now. So in scenario number one, let's say in the future, corn feed prices go way, way up. Who would be making a better deal and why? Just take a second to think about that, right? From the farmer's perspective, if corn feed prices go up, what are they going to have to do to their beef prices, right? And if the beef prices go up, what does the buyer, in effect, have to do? So think about those two options. Take a second, and we know that the seller made a potentially bad deal, and the buyer has locked in a really good price. So if the price of corn feed needs to go up, then it's very likely that the seller is going to need to raise the price of their beef in the future. So by locking in this contract here at 85 cents, let's say that the price in the future goes from 85, let's say now it's trading at $1 per pound, right? 15 cents higher. The seller technically just lost 15 cents per pound of beef that they've agreed to sell. And the buyer has just made, on the other hand, the 15 cents that the seller has lost because they've locked in a much lower price than the given market rate now at $1. So I hope you can see how through this example here, each party is trying to hedge their risk for the future of market volatility. Another example here might be that the price of farmland decreases. In this scenario, what is going to happen? Again, think about this critically. If you're the farmer and the price of farmland decreases, and you're the buyer and the price of farmland decreases, who is this good for, right? So think about it, and we know that in this case, the seller actually made a much better deal. Now, why is that? Well, if the price of farmland decreases, then more people can afford to become farmers. So as more farmers pop up, there's more meat on the market. So let's say there's an abundance of these cows. So we'll just put a bunch of pluses over here for more cows in the world, which is, good or bad, depending on how you feel about cows. But there's more cows in the world, which means that there's more supply, and therefore it's going to take care of demand and prices should go down. So let's say now that from 85 cents where this price was locked in, now prices are trading around 50 cents per pound of beef. So the seller has locked in that 85 cent price, and the buyer has also locked in the 85 cent price, and the buyer is technically paying now 35 more cents per pound of beef than the current market value, which is now 50 cents per pound. The seller is making out great because they've hedged their risk by entering into this contract and securing that 85 cents per pound. So that's how the futures market was designed to work, but that's not actually how we're going to use it as traders. Let's take a look at how we're actually going to make money from this. So it's great that we now have the history in place to understand why the futures market came about, but how do we actually trade it in today's day and age? Well, you'll notice that I said a key word right there. We're going to trade the futures market primarily, and it's very, very rare. I can't really think of one situation where anyone would actually take delivery of the commodity that they're trading. Remember that in our beef example, we were talking about a unit of 40,000 pounds of beef. Do you really think it's practical for anyone to take on or take delivery of 40,000 pounds of beef? I mean, if you're some mega corporation and you have a huge freezer and that's what you do as your primary business, then maybe, right? Maybe it makes sense for you to take on 40,000 pounds of beef in one shot. But I would say it's extremely rare for anyone to ever take delivery just for practicality reasons. So how can we actually use these contracts? Well, we can just do the same as what our historical people who invented the futures market were trying to do. We can hedge them, but we're going to trade them instead of actually take delivery. So if you think that the price of beef is going to go up in the future, then maybe you buy some beef contracts now, but you don't actually take delivery of that 40,000 pounds of beef. You cash them out in the future to hedge against and make some money against whatever it is that you're doing in the future. Whether or not you're buying beef at the market price, you just made up the difference by trading that beef contract. There's also something that's been introduced called the financials futures market, which make hedging market positions or market volatility much easier. So associate these financial futures with things like the indexes. So, the big three that come to mind are going to be the S&P 500, the Russell, as well as the NASDAQ, right? We also have currency futures. So we can, trade futures that are impacted by the dollar, the Great British Pound, the yuan. We can also trade against interest rates, right? So all of these financial assets and financial classes also have futures tied to them. But don't get me wrong, there's still going to be a buyer and a seller. Even though we're not actually exchanging physical goods here, there still needs to be a buyer and there still needs to be a seller. And don't forget, if this buyer and if this seller agree at X in terms of unit and in terms of X on price at X date in the future, they are both obligated to fulfill that that agreement, right? The buyer needs to put up the money and the seller needs to put up the asset. Okay, so that doesn't go away here just because we're actually trading the contracts and not taking delivery. So how do you make money as a trader? Well, it's very simple. Just like we have in the stock market, we can go long and we can go short. If you're familiar with options, we can buy calls and we can buy puts. It's the same here in the futures market. If you expect prices to go up, you simply want to be a buyer because in the future, you can sell that contract for a higher price. If you expect prices to go lower, then become a seller, right? Go short here because you're expecting to be able to buy that contract back at a lower price. If you're familiar with options, you know that you would associate prices going up with calls and prices going down with puts. So another key aspect of the futures market, which I think makes it really unique and a great opportunity, is that you can place as many trades as you want in whatever direction you want every single day without having to worry about a pattern day trading rule. Now with equities, in the United States at least, you need $25,000 at minimum in your account to be classified as a pattern day trader. And what this allows you to do is trade more than 3 times, 3 day trades that is, in a 5-day rolling period. So if you have less than $25,000, you can only make 3 day trades per week. But in the futures market, these restrictions do not exist. You can place as many trades as you want in whatever direction you want, as many times a day as you want. So no pattern day trading rule here in the futures market makes it extremely powerful. Now let's jump into some more nitty-gritty here and understand points versus ticks. So from now on, I want you to associate all futures pricing with points and ticks. You'll notice over here on our example in the gray sidebar that there's no dollar sign before this number 1,000. There's also no pound sign, right, before that number 1,000. Instead, it's just simply 1,000. Now 1,000 what? 1,000 points. If we look over here on the left-hand side, we'll notice that a point is the smallest unit that price can move to the left of the decimal point. So anything that happens on this side is referred to as a point. So in this example here, when we go from 1,000 to 1,001, you could just say that this was an increase of plus 1 point. Now, what does that mean for ticks? Well, a tick is going to be the smallest unit that price can move to the right of the decimal point. And again, remember, no dollar sign, no yuan, no pound, no rupee, nothing. It's just 1,001.01 points. But in this example, remember that we can call this increase that happened on the right of the decimal place. So from here to here, this increase that occurred was plus 1 T for tick. Now, it's very important to understand that every single commodity has a different tick size and a different tick value, okay? Very, very important to note. The reason there's a burning car in the background here is because if you're not familiar with the tick size and the tick value, you can quickly find yourself in a very bad situation. Let's say that the tick value was way higher and the tick size was way smaller than you anticipated. Well, very quickly, you're going to find yourself again in a very tough spot. So on some more common symbols that we look at, let's just have a quick glance at tick size and tick value. The ES, and keep in mind that all futures symbols are going to start with a forward slash. So the ES is going to equate or be equivalent to the E-mini S&P 500 contract. Think of this as being equivalent to, in quotes here, the market, right? The S&P 500 is oftentimes referred to as the market. It's the SPX and it's the SPY, right? You may have traded those things, whether or not it's shares or options. This is the futures derivative of those products. Next up, the tick size here in the E-mini S&P 500 is 0.25. And remember, this isn't 0.25 meaning a quarter or 25 cents. It's 0.25 of a point. So in order to make up a full point, we multiply this by 4, right? And we get a full point move. But the tick itself, if I just get rid of what we just drew, 0.25 of a move, of a point here, or a one tick move in the ES is going to equate to a $12.50 move on your contracts. So right off the bat, can you see how leveraged these products truly are? A futures contract is certainly not for the faint of heart, and I don't say that to intimidate anyone. I just need you to be aware of how these pricings actually affect your contract value. So one tick in the ES is going to mean plus or minus $12.50. If we think about, again, going back to a full point, let's just remember that we had to do a times 4 multiplier here. That means a 1 point move in the ES is 1250 times 4, which means that a full point move in the ES is equivalent to a $50 gain or loss on your contract. So that's a very easy example because we're talking about quarters, right? The same thing holds true in the NQ, which is for our NASDAQ, the QQQ as the ETF, and the NDX as the index. Again, we have a times 4 multiplier here for our tick. A tick is a quarter of a point, but this time the tick value is only $5. And I know I just said only, but as we'll see in that live video at the end here, the NQ, it's going to move 10 times faster than the ES. So don't be fooled by the fact that the tick value here is actually lower than the ES. I would argue 100 times that the NQ is much more volatile than the ES. Now, let's look at some more different examples as we go on that aren't as simple, right? The first one that we'll sort of start off with is the Russell. The Russell tick size is 0.1, meaning that we actually have a times 10 multiplier. But you'll notice the tick value is the same as the NQ. So when the Russell moves one tick, you're making $5. When the NQ moves one tick, you're making $5. But here's the difference. When the NQ moves one full point, we'll just put that in quotes here, you're making $20, right? Because this is a times 4 multiplier. If we multiply 5 times 4, not to insult anyone's intelligence here, that's going to give us a full point value of $20. If we look at a full point here in the Russell, right, we have a times 10 multiplier. And again, not to insult anyone's intelligence here, but a full point in the Russell is now going to be worth what? Well, $50. So again, I bring that car example up because it's so important that you understand how the contract you're going to be trading is going to move. The most aggressive one here on the board is probably going to be our silver, right? If we look at this down here, that's a times 200 multiplier. We're talking about 1/1000ths of a point. So every time silver moves one tick, you're getting $25 of movement in your contract. And remember that if we multiply this by 200, right, that's going to be a $5,000 move per point, which is just absolutely insane, right? So definitely be aware of your tick size and your tick value. The bonds are also pretty interesting. We have some interesting decimals here. I'm not going to get into the math behind them, but just know that as these decimals start to get crazier and crazier, you're always going to round down your tick size instead of round up, okay? So always keep that in mind. Now let's get into some concrete examples here. I first want to start out with the bread and butter here, the ES. Now, the way we know we're looking at the ES in this example is up here in the top left. You can see /ES. Now, okay, we have the ES, the E-mini S&P 500. How many points did we move here in this move? So what I want you to focus on, and just for simple math here, we're using 3750 all the way up to 3835. What's the distance of that move? Well, if we do the subtraction there, we know that we had a move of about 85 points. We know that the E-mini S&P has a multiplier of 4 ticks per point. So if we now multiply, again, those 85 points by 4 ticks per point, we're left with 340 ticks in this move in the chart here, from level down here all the way up to the level way up there. Now, how do we actually assign a dollar value to that? Well, we know the tick value of the S&P is $12.50. So if you multiply 340 ticks per $12.50 per tick, you're looking at a move here, if you only bought one contract, of $4,250. Now, keep in mind, that's great if you were on the right side of the trade, right? If you were a buyer at this level on the breakout, fantastic. You just made a bunch of money. But if you tried to sell this short up here, if you were a seller and went short the futures contract and you held on to this, you would now be down $4,250. Okay, so leverage certainly works in both directions, and that's something I always want you to be aware of. Let's go through another example. This one is going to be on silver. Again, how do we know it's silver? If we look up in the top left on this example, we see /SI. So symbol here is definitely silver. How many points have we moved? Well, we know that points are on the left of the decimal point. So over here, we can see we went from 30.211 all the way down to 26.355. Now, if we do the math, again, just make it simple for you, it's 3.856 points. How many ticks is that? Well, we know that there's a 200 multiplier on silver. So there's the math there. We're left with 771.2 ticks. But remember, we're always going to round that down. So now if we do 771 times $25 per tick, this move here in silver was worth just shy of $20,000, right? And again, remember, leverage works both ways. If you shorted silver here, phenomenal. You just made about 20 grand on this move to the downside. But if you tried to buy this breakout, you were expecting prices to make a new high, then you're now in the hole $20,000 about if you held it all the way till down here at the bottom. So again, I drive home the point here that leverage is going to work with you or against you very, very quickly. So one thing that you may encounter in the futures space is these symbols that look longer than just /ES. Now, if we break this down, we need to sort of separate symbol from date. Okay, so as we know, this transaction here is going to be happening sometime in the future. So this is how we tell what time, right, this is going to happen in the future. First of all, this piece right here correlates once again to our E-mini S&P 500. The first two letters, sometimes three, as we saw with the Russell, is going to tell you what contract you're trading. The next letter, this one here in the middle, is going to tell us what month our contract is expiring, aka when we would be expecting delivery if we were trading these as traditional futures. And then the last two digits, sometimes it's abbreviated as 1, are going to tell you the year in which the contract is expiring. So three pieces to the same sort of pie, if you will. And if, just to give you a heads up on what you may encounter here, the month is always going to be changing, right? It's always going to be rolling over into the next month. And here at the bottom, these are the month codes, okay? So January is F, February G, so on and so forth. If you want to save this as reference, feel free to take a screenshot. You can easily find it online, but always know that the letter is going to correlate with what month your contract is expiring. So how much does it actually cost to get involved and start trading futures contracts? Well, margin is going to help us out a ton because, as we'll see in just a moment, to buy a futures contract, it would actually cost a ton of money. So margin is simply borrowing money from your broker. You're going to put up a small fee and they're going to cover the rest. Let's use ES as an example to illustrate how much it would actually cost to buy one contract. As we know, there's technically no dollar sign in front of the ES point value. Again, this is 3,800 points, not necessarily dollars. So it does not cost $3,800 to buy one contract. How much does it cost? Well, let's take a look at this objectively, right? We know that points are converted to ticks by using a 4 times multiplier in the ES. That leaves us with 15,200 ticks times 1250 per tick. It's going to be a whopping $190,000 to buy one full ES contract. So that's not the price that we actually have to pay. This price right here, if someone starts to get fancy with you and starts to throw around some big words, that's oftentimes just referred to as the notional value of the futures contract. But the cost for us to get involved is going to be the margin requirement by our broker to buy or sell whatever contract it is that we're looking at. One thing I would remind you of is that because each contract, each symbol is going to have different tick sizes and tick values, each contract is going to have different margin requirements, right? So always remember that when it comes time to looking at the contracts, determining if you can afford one and how many you can afford. It's always something to keep in your mind along with the tick size and tick value of every contract. Next thing is that each broker probably has a different way that they manage risk. So during the day, they can offer different day margins. But as we'll see in just a moment, at the end of the day, they have to put up something which is called initial margin. And as a matter of fact, let's just jump into the 3 types of margin right now. But just know that brokers can offer different day margins depending on the way that they manage their own firm risk. So the 3 types of margin are up here at the top. We have day margin, initial margin, and maintenance margin. Let's talk about all the different types first, and then we'll walk through a sort of example with some theoretical values. So day margin is going to be the amount required, capital required in your account to buy and initiate or sell and initiate a new futures position during regular trading hours, which is between 9:30 Eastern and 4:30 Eastern, okay? So it's 30 minutes after the cash close in the stock market. The futures market actually goes on for about another 30 minutes. So day margin is the amount required during the daytime or regular trading hours session. Initial margin is now the amount required to initiate or hold an existing position from the daytime frame into extended hours trading. So think of this as like this. So as we approach that 4:30 mark, which is going to be the futures close here on the East Coast, when we approach 4:30, you need to have the full initial margin amount in your account to hold that position, if you want to hold it, into the extended hours session. So if you're a day trader, you're only concerned with day margin. You don't really care about initial or maintenance margin. If you're a swing trader or a position trader, you're going to want to know what the day margin is, what the initial margin is, and as we'll talk about in just a moment, what the maintenance margin is. So initial margin, very critical and kicks in for a split second at the 4:30 bell. Now, why is initial margin the same all across brokerages? Well, that's because initial margin has to do with the settlement of contracts as the bell rings. So your broker is actually going to an exchange to do exactly that, exchange futures contracts, and as the bell closes at 4:30, settlement time, they need to put up the capital required to actually buy and sell all of the contracts and exchanges that they facilitated that day. So day margin is oftentimes going to be very small because you don't actually need that amount of capital when it comes time to settle, right? Because if you do +1, and then you do -1 to sell within a day, the same day period, those are going to cancel each other out when it comes time at 4:30 to settle up with the exchange. If you want to be someone who swing trades though, and you want to maybe hold +3 into the overnight session, now your brokerage has to put up the capital to cover those +3 positive contracts here in whatever futures market you're deciding to trade. So hopefully that clears up initial margin. Now, maintenance margin is a little bit different. As soon as initial margin has been provided, the exchanges they're like, okay, good. We see that you have the capital. You're good for this. Now we're going to lower it slightly to see, to ensure that your clients are going to meet a minimum here. We'll loosen it up a bit, give them a little bit of wiggle room, but not much, right? So initial margin is usually much higher than day margin, and maintenance margin is usually slightly lower than initial margin here. So it's going to be the amount required in your account, including the position that you hold into the overnight session, to withstand any drawdown in the extended hours session. Now, drawdown simply refers to the position that you're holding going against you. So just for round numbers sake, let's say that you enter the after hours session with a $100 position size. So here, technically your position's worth $100. Price starts to go against you, and now your position is only worth $50, right? Even though you haven't sold, it's technically only worth $50 right now. That's a difference here. And again, not to insult anyone's intelligence, that's a $50 drawdown. So maintenance margin is going to be the amount required in your account if the position starts to go against you to maintain that position overnight. And again, that's happening in the extended hours session from 6 to 9:30 the next morning. Let's walk through a scenario now here and sort of cover all of these different types of margin. Let's say we want to trade the E-mini S&P 500 futures. So ES, as we know right now, is trading somewhere around 3,800. Let's just say that we want to buy two contracts here at, let's just say for round numbers sake, 4,000 points. And remember, this is not $4,000. This is 4,000 points. Let's say that our day margin up here is going to cost us $500. Okay, so in order to initiate this position during the day time frame, remember between 9:30 and 4:30 in the afternoon, it would cost us how much money? Well, we're looking to buy two contracts here, and $500 is the initial day margin amount. So it would cost $1,000 to get involved in two ES contracts here because day margin is $500 per contract. Next up, let's say we want to hold one of these contracts overnight. Let's say initial margin here is twice the amount of day margin. So let's say $1,000 for initial margin. Let's say that our account value in this example, we started out with $1,000 in our account. We were able to execute the day trade here and buy those two contracts because we had the $1,000 in our account. When the bell starts to ring at 4:30, we are now going to need to put up $1,000 per contract. But we know that we're trying to trade two of them into the extended hours session, and that's technically going to cost us for initial margin $2,000, right? Because it's two times the initial margin requirement per contract. But our account value is only worth $1,000. So one of two things is going to happen at this point. Your broker will give you a phone call and they're going to ask you, hey, would you like to liquidate your position to get rid of this and, bring your margin back into check? Or would you like to add more money to your account and, bring the value up to the initial margin requirement? So in this case here, you would have to deposit another $1,000 to meet this $2,000 margin requirement. The other thing that you could do here is what? Well, if we have two contracts and the initial margin requirement is $1,000, we can sell one, and now if we only have one contract headed into the after hours session, the initial margin is only $1,000. So because our account value back here is still $1,000, all set, all good to go. We can hold this into the overnight session. So all good. We've cleared that up with our broker. We have one contract going into the overnight session. Now let's say that maintenance margin is now going to be somewhere in the middle. For round numbers sake, we're just going to call it $750. We have one contract, so now after we've already met that initial margin requirement, it's going to drop down to maintenance margin, or because we have one contract, $750 per contract. And again, these are theoretical examples. We will look at some concrete numbers in just a second. So maintenance margin is $750. Let's say we got into the ES at 4,000 points, right? What happens if during the overnight session, now price goes all the way down to, again, this is completely theoretical. I'm not saying ES would ever do this. Let's say it drops 1,000 points overnight, right? At some point in time, because you had $1,000 tied up in that one contract, it's going to be worth much less than $1,000. So if that amount is starting to go below our 750 maintenance margin requirement, you're going to get another phone call from your broker, and they're going to say, hey, your maintenance margin requirement is being tested, right? It looks like your account value may no longer be worth the 750 required to hold this one contract through the night. Would you like to A, liquidate the position, sell the contract, or B, deposit more money into your account? And if you choose option A, they'll simply sell the contract for you. If you choose option B and request to deposit more money into the account, you will actually have to bring it back to the initial margin requirement. Okay, so you don't have to meet the maintenance requirement now. You have to actually go all the way back up to the initial margin requirement. Once you meet that initial margin requirement, then it drops back down to maintenance and you're good to go. You may be saying, why does that happen? Well, oftentimes it's to give your account a little bit of cushion as you head into the rest of the overnight session. They don't want to be calling you up every 5 minutes as your account starts to dip back below. If the trend of the night keeps going against you and you're experiencing drawdown, they don't want to have to keep calling you up over and over and over again. So that's why oftentimes you will have to bring your account value all the way back up to initial margin and not just the maintenance requirement. So I hope this was sort of helpful in understanding how the three types of margin work. Let's have a look at a few different real-life examples here. The top one with the white background is one brokerage by itself, and this is another brokerage down below here. What I want you to take away from this is the difference and similarities across initial, day, and maintenance margins, okay? So in the ES, we'll just stick with this one. I was actually pretty close in my example, right? In this broker in particular, they only require $550 in your account during the daytime to buy and sell one ES contract. Now, the initial margin, again, is going to be the same across all brokers because they need to firm up with the exchange, right? They need to settle with the exchange all at the same price. So initial up here is going to cost $12,100. Now, keep in mind, that's still drastically less than the $190,000 that the ES contract is actually worth. So margin is still a huge levered advantage. Now, in this case, nighttime margin refers to maintenance margin. They just happen to call it nighttime, and you'll notice that, again, it's a huge relaxation here. And this is because the broker actually has some discretion on how much margin you actually need in play because they've already settled up with the broker. You've proven to them that you have enough money in your account to meet the initial margin. Now, in our bottom example, again, we're looking at the same thing, the ES down here. Intraday margin or day margin is now only $500. It's $50 less than the broker above. The initial margin is still the same amount. Remember that that's always going to be the same because of the settlement issue. Now, in this particular broker as well, maintenance margin, you can see, is still $11,000, whereas here it's only $1,000. So this may be something that you want to shop around for. Again, it's all going to depend on the particular contract, whether or not you plan on holding contracts overnight, how many contracts, can you meet the initial margin, do you need to make sure that nighttime margin is less? If your account can't quite withstand a huge drawdown, maybe that's a benefit to having a lower nighttime margin or maintenance margin cost. These are all things that you need to actually make a decision upon, but now you at least know how all of these things work. So the other thing that will be very specific to the broker you choose is going to be the commission and fee structure. Once again, we have two brokers up here, the top one here and the bottom one down here. For consistency's sake, we will be looking again at the ES. If we do something like this, we'll notice that we're paying an exchange fee here. Looks like there's a clearing fee and then the actual commission fee, which goes to our broker. We're going to ignore the active trader and the commission-free options. Those are things that you can upgrade to with your broker if, at the end of the day, you're trading more contracts. It makes sense to potentially join one of these additional tiers. But again, we'll just focus on the free tier for consistency's sake. 79 cents goes to the broker, and at the end of the day, your all-in fee will be $2.13 per contract that you decide to trade. Now, very important note here is that if you decide to buy one contract, you're paying $2.13. If at some point in time you decide to sell that same contract that you just bought, well, it's going to cost you an additional $2.13. So always clarify with the broker before you sign up the commission structure, right? Is this per trade or is this round trip, as we'll call it, meaning the full thing here? So always clear that up before you decide who you want to choose as a broker. Very important to understand. In the example down below here, again, we have a ES and we have a number of different tiers we can join. We'll focus on the free one, which is here. And let's go through our fees, right? We have the same exchange fee. This time we have an order routing fee. And our free commission rate that goes to the broker is $1.29. And all in here, it looks like our full commission rate is going to be $2.69. So this broker down below is obviously going to cost you more money per trade than the one up above. And again, this is $2.69 per buy or sell. So this here would cost you $2.69, and this here, closing that same contract, would still cost you another $2.69. So once again, always clarify with your broker whether or not that's per trade or per side, sometimes you may see that called, or round trip. And lastly, talking about our tax advantages here in trading futures. Now, right off the bat, I want to say I'm not a certified public accountant. I would definitely encourage you to go talk to a professional, but futures are taxed under what's called a 60-40 rule. Basically, what this means is any gains we make in the futures market, 60% of those gains will be taxed as long-term capital gains. 40% of those gains will be taxed as short-term capital gains. Now, if you're not familiar with trading taxes at all, just know, very briefly, again, this is going to depend on what category you fall into, which is why I recommend a accounting professional, but long-term capital gain rates are much less than short-term capital gain rates. So again, this is one advantageous property of trading futures. It's one reason you may see Forex traders start to trade the futures contract on any given Forex pairing or Forex currency, right? It's because there's a tax advantage to trading in the futures market as opposed to the equity, options, or Forex market. So it's something to consider along with that pattern day trading rule sort of workaround as well. And without further ado, let's take a look at some real live price action in the futures market. All right, so wrapping this video up, I just want to show you some real-time price action here in the futures. We're looking at this symbol up at the top on this tab. Now, you tell me, what does this stand for? We have ES. What does that stand for? Hopefully what you're saying is E-mini S&P 500. If you were a cheater, you would have looked right here. But anyways, after that, we have H, which stands for our contract month. This one just so happens to be March. And then we have the 1 after that. And 1 in this case is an abbreviation for the contract expiration year, which is just 2021. So that's how we know we're looking once again at the E-mini S&P 500s, and we're looking at this particular contract here, expiring in March of 2021. Now, the 500T that's after that is just sort of telling us about this technical chart. It's a 500 tick chart, meaning every time ES ticks 500 times, a new candlestick will print. Now, I'm not going to get into the specifics of technical analysis here. That's for a different video, different time. But at some point in time, you need to understand and learn, or at least be able to predict in some way what direction you think price may be headed, right? If you have no idea, you're a 50-50 gambler. But if you have some idea of which way price could be headed, then you can start to take action in these futures. Now, what I want to cover is the cost to get involved here in the ES, right? If I were to click the buy button right now, am I really paying $3,827.50 to buy one contract? This is a quiz question for you, yes or no. Hopefully you've thought about it for a second, and the answer is no, right? That's not actually what I'm paying, because this isn't a dollar value here. That's just what the contract is worth in terms of points. What I would be paying is the $500 or so that are required by my broker as day margin to get involved in one ES contract. Up at the top here, you can see that this particular broker will tell me what percentage of my day margin I've used and what percentage of my initial margin I have used. Okay, so very handy when it comes time to determining whether or not you want to hold something after the close, right? Just for example's sake, and as a quick quiz question, let's say I buy one contract right now. I'm not going to do that because I'm not actually seeing a setup, but let's say I do buy one. It'll take up $500 of day margin. But let's say right now, I'll just give you a quick little example. Right now, it is 2:30 in the afternoon on a Friday. If I wanted to hold this contract until Monday, what would I have to have in my account to do that? Hopefully you've taken a minute to think about it. And when the bell comes at 4:30 in the afternoon, right? If I don't have the initial margin requirement in my account, I'm going to get a phone call from my broker, and they're going to say, you either need to increase the amount of capital you have in your account, or we're going to liquidate your position because you're not meeting the margin requirement. So very good to know when initial margin is going to kick in. Again, 4:30 or any time after the regular trading hours session, you need the initial margin per contract to be able to hold that past the close, okay? So if not, you're going to get a phone call, and just be prepared for that. The broker will give you a courtesy call generally about 15 minutes, 30 minutes before the market officially closes, if they're a decent broker, right? And most brokers are these days. Now, the other thing I want to focus on here is what's going on the left, right? This is our price ladder, and it's telling us what's going on with price, right? We can buy and sell over here. But what I want to talk about for a brief moment is we obviously know that in between prices here, it looks like about a 25-cent increase. But is it truly a 25-cent increase? Hopefully what you're saying is no, right? It's actually a 1 tick increase, and we know that the minimum tick size of a point is a quarter of a point, or 0.25. So although it looks like it's moving in 25-cent increments, it's really moving in tick increments. And as we know with the ES futures now, the cost or the price associated with 1 tick here is $12.50. So for every time it looks like price is moving 25 cents here, really, we're talking about a $12.50 gain or loss, depending on what side of the contract you're on, right? So very important to note there. Every time this yellow box moves, someone is either winning or losing $12.50. Now, this is on the ES. Let's go ahead and take a brief glance at the NQs, which, as we know, are the NASDAQ futures. I'm going to flip this chart over to the NQ as well. And what I want you to focus on here is just the difference in speed. You'll notice very, very quickly how different these two contracts act. If I expand this a bit so we can actually see what's going on, look at, first of all, the price of an NQ contract right now. If I scroll to where we are on the chain here, you'll notice we're looking at about a 13,000 point, not dollar, point contract. Now, how much is each tick worth here in the NQ? Well, if we remember back to that chart, each tick is worth $5, so 1 point is technically a $20 move here in the NQ. Now, look at how fast this yellow box is moving compared to what we were seeing in those S&P futures. It's already off the screen. Look at that. I mean, it just keeps going. So the volatility here in the NQ is much higher. And it's much higher, but our tick value is much lower. So it's a little bit of a trade-off. And again, something you need to be aware of if you decide to start trading futures, okay? So each time we move what appears to be a 15 or 25 cent mark here in the NQ, we're really moving $5, all right? And because of how fast it's moving, again, remember that the NQ is going to be very volatile. You can make a lot of money, or on the flip side of that, lose a lot of money very quickly here trading the NQ. Before I go, I do want to mention the fact that there are micro contracts out there. So specific to the ES, right, if we click over here, I'm going to type in MES, which stands for micro ES. You can see when I click on it, we come back to our ES, what looks like the same pricing of an ES contract. I'll do the same here. We'll go with MES H1, and this is the micro contract. And you can look into these, definitely do your own research on them, but all they are is a 1/10 size of our ES contract. So instead of the tick value being $12.50, the tick value here on an MES contract is $1.25. So much more forgiving. And if you're looking to get involved in futures for the first time, this is a great starting point. I mean, with a $1.25 tick price, there's not a whole lot of risk here, right? You can put one contract on, and if price moves a full point against you, you're only down about $5. Okay, so definitely something I would recommend to any newer traders looking to get involved in the futures market. So all of that said, I'm going to wrap the video up here. I really hope you learned something new, whether or not it was about how the futures market started, anything that we talked about in terms of ticks and points and margin requirements, or even the tax benefits associated with trading futures, okay? So if you did learn something, let me know down below in the comments section or by simply leaving the video a thumbs up. That being said, I hope you check out the rest of the channel. We do a weekly watch list analysis every single Sunday where we break down the stock market and give you some playable levels to watch out for. And that being said, I'm going to wrap it up for good. I wish you a green trading journey here in the futures, and I hope to see you around the channel.